I'm Cynthia Rowland, and this is episode 58 of EO Radio Show. Today, I'm talking about the meaning of expenditure responsibility, or so-called ER grants, made by private foundations. The term expenditure responsibility refers to the rules that a private grant-making foundation follows in order to avoid the onerous penalty tax on a grant or transaction that would otherwise be a taxable expenditure if made by the private foundation. Taxable expenditures include a variety of types of grants and expenses paid by the private foundation, which are prohibited by the Internal Revenue Code. These types of prohibited payments include lobbying, politicking, and candidate campaign expenses, grants to individuals for travel, study, or other similar purposes, unless certain requirements are met, and grants that are not for a charitable purpose. A final bucket of grant types that can cause a foundation to be penalized under these rules are grants made to organizations that are not classified as a public charity or an operating foundation, unless the foundation exercises expenditure responsibility with respect to that grant. So this is where the ER rules come into play. Expenditure responsibility is comprised of 5 requirements: a pre-grant inquiry, a written grant agreement, written reports from the grantee, grantor reporting requirements to the IRS, and grantor record-keeping requirements. We'll walk through all 5 elements in this episode. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. So today, I'll walk through the 5 requirements for an expenditure responsibility grant to qualify and not be treated as a taxable expenditure. Here are the 5 requirements. Number 1, pre-grant inquiry. Number 2, written grant agreement. Number 3, written reports from the grantee. Number 4, grantor reporting requirements to the IRS. And number 5, grantor record-keeping requirements. After going through these 5 requirements, I'm going to wrap up the episode with a discussion of the penalty taxes. So stay tuned to the end if you want to know the details for a foundation that violates these rules. So starting with part number 1 of expenditure responsibility, that is the pre-grant inquiry. Now that's the term used by the IRS. In many circles, this type of investigation is known as due diligence. But under the code, the terminology used is pre-grant inquiry. Here's a short overview of what qualifies as pre-grant inquiry. The grantor private foundation must conduct a limited inquiry which is thorough enough to give a reasonable person assurance that the grant recipient will actually use the grant for proper tax-exempt purposes. Failure to make such an inquiry will, in and of itself, cause the grant to be a taxable expenditure. So it's really important that the grantor private foundation has suitable evidence that an appropriate pre-grant inquiry was undertaken. So the pre-grant inquiry and its documentation should include all of the following elements: the identity, prior history with the grantee, and experience of the grant recipient, the grantee, and its managers; any knowledge that the foundation has based on its prior experience of or other information which is readily available concerning the management activities and practices of the grant recipient. The scope of the pre-grant inquiry may vary in each case depending on the size and purpose of the grant and the period over which it will be paid, as well as any prior experience of the foundation with the grant recipient. So, for example, for a small grant to an organization that the private foundation has funded in the past, the pre-grant inquiry might be limited because of prior experience with the grantee using the funds appropriately and providing the reports, and this relatively small size of the grant. For a very large grant to a new recipient, much more detailed pre-grant inquiry would be appropriate. So the second element of expenditure responsibility is the requirement of a written grant agreement. To meet the expenditure responsibility requirements, each grant must be made subject to a written commitment signed by an appropriate officer, director, or trustee of the grantee organization. Failure to comply with the requirement to get a written signed grant agreement will cause the grant to be a taxable expenditure. For purposes of the grant agreement, the regulations distinguish and provide required provisions for each of the following types of grant agreements. There are specific requirements for a conventional outright grant. Other requirements apply for a program-related investment, and grants to foreign organizations also require additional elements. For purposes of this episode, since most foundations generally only deal with conventional outright grants, I'm only going to detail the required provisions for those type of grant agreements. For a conventional outright grant, the grant agreement must include all of the following provisions. Number 1, the grant recipient must agree to repay any portion of the grant not used for the grant purposes. Number 2, the grant recipient must submit full and complete annual reports on the manner in which the funds are spent and the progress made in accomplishing the purposes of the grant. Number 3, the grant recipient must maintain records of receipts and expenditures and must agree to make its books and records available to the grantor at reasonable times. Number 4, the grant recipient must not use the grant for any of the following purposes. Those prohibited purposes are to carry on propaganda or otherwise attempt to influence legislation, to influence the outcome of any specific public election, or to carry on directly or indirectly any voter registration drive, to make any grant which does not comply with the individual grant requirements of the Treasury regs and the code requirements for grants to individuals. And finally, the grant recipient has to agree not to use the grant to undertake any activity for any non-charitable purpose, that is, for any purpose other than those that are described in the Internal Revenue Code Section 170C2B. Finally, the grant agreement must also specify the purposes of the grant. Those purposes may include contributing to a capital endowment, aiding in the purchase of capital equipment, or providing general support, among other things, as long as neither the grants nor the income from the grants can be used for any of these prohibited purposes. If the grantee is not a tax-exempt organization, the grantee must also agree to hold the grant funds in a segregated account. This comes up, for example, when a private foundation makes grants to a for-profit business to accomplish a particular charitable purpose. That does come up from time to time, and it's perfectly allowable as long as the grantee agrees to all of the other requirements in a written agreement and agrees to hold the funds in a separate bank account, separate from its other operating capital, its other bank accounts. So those are the elements of the required written grant agreement. Now, the third element of expenditure responsibility is the requirement of written reports from the grantee to the grantor. The rules require that the grantee provide annual reports to the grantor. The grant recipient must compile and furnish to the grantor within a reasonable period of time an annual report at the end of the annual accounting period within which the grant is received, as well as all subsequent accounting periods until the grant funds are fully expended or the grant is otherwise terminated. The annual report needs to include all of the following: a statement about the use of the grant funds by the grant recipient, the grant recipient's warranty that it has complied with the terms of the grant agreement, and finally, the progress made by the grant recipient toward achieving the grant purposes. In addition to the annual reports, the grant recipient must make a final report on all expenditures made from the grant funds, which should indicate the progress made toward the grant goals. The final report is due within a reasonable period after the close of the annual accounting period during which the use of the grant funds is completed. Now, there are special rules for capital endowment grants, and this is important because a lot of private foundations may want to make a capital endowment grant to another organization, typically to another private non-operating foundation. So, if the foundation makes a grant to another private non-operating foundation, which is exempt from tax under 501c3 but is a private foundation and not a public charity, and the purpose of the grant is to increase the grant recipient's endowment, aid in the purchase of capital equipment, or some other capital purpose, the grant recipient must provide the grantor foundation with capital endowment reports concerning the use of the principal and any income derived from the grant funds. The grant recipient must make the reports annually for the taxable year in which the grant was made and for the immediately succeeding 2 taxable years. Then, if the private foundation grantor agrees, the grantor may cease requiring these reports from the capital endowment grant recipient, but only if it is reasonably apparent to the grantor foundation that before the end of the second succeeding taxable year, neither the principal, the income from the grant funds, nor the equipment purchased with the grant funds have been used for any purpose which would result in liability for tax under the expenditure responsibility rules. So in short, the grantor foundation can terminate the annual reporting requirements for a grantee of an endowment grant if it is reasonably apparent to the grantor foundation that the endowment funds will be properly used. The grantor foundation is not required to conduct an independent audit of the reports from the grantee, whether that's the annual or the final report, unless it has reason to doubt the report's accuracy or reliability. The grantor foundation is not guaranteeing that the grantee used the funds appropriately, but it does need to act reasonably in looking at the reports that it's received and being aware of other reports about how the grantee might have misused the funds. So what happens if the grant recipient fails to furnish a grant report? Failure by a grant recipient to furnish the required annual or final report to the foundation does not automatically cause the grant to be treated as a taxable expenditure by the grantor foundation, but they do have to withhold all future payments to that grantee until the reports are current. So number 4 is the foundation reporting requirement to the IRS. The rules require the grantor foundation to report the following information on its annual information return, that is the Federal Form 990-PF, PF for private foundation. So the grantor foundation reports on its 990-PF with respect to each grant made during the year that is an expenditure responsibility grant, and it has to include all of the following information: the name and address of the grant recipient, the date and amount of the grant, the purpose of the grant, the amount spent by the grant recipient, whether the grant recipient has diverted any portion of the funds or the income therefrom in the case of an endowment grant from the purposes of the grant, the dates of any reports received from the grant recipient, and the dates and results of any verification of the grantee recipient's reports undertaken under the Treasury regs. So you can see that's fairly extensive reporting requirements, and an expenditure responsibility grant would not be appropriate in a case where the grantee doesn't want that level of transparency about the grant. But as long as the grantee and the grantor are okay with disclosing this amount of information, this element of the expenditure responsibility requirements can be met. The failure by the grantor foundation to report all this detailed information on its 990-PF will cause the grant to be considered a taxable expenditure. The IRS applies this rule and all of the other ER rules strictly, and has held that if a grantor foundation files an amended return containing the information that was omitted on the original return, and the amendment is filed after the due date for the original 990-PF, the taxable expenditure has occurred and it can't be fixed. So the amended return will operate as a correction of the failure, which will prevent imposition of the second-tier penalty taxes, but it doesn't negate the original penalty tax. And I'll get to those taxes in just a minute. So anyway, the takeaway from that is that the 990-PF needs to include all the details on all the expenditure responsibility requirements, or all the expenditure responsibility grants in a timely filed tax return. So element number 5, the foundation's record-keeping requirements. The foundation has to keep records of all of the foregoing actions that comprise the expenditure responsibility requirements. And the foundation has to be able to make these items available to the IRS if requested by the IRS. And these are copies of each written grant agreement covering each expenditure responsibility grant made during each taxable year, a copy of each report received during each taxable year from each grant recipient with respect to any expenditure responsibility grant, and a copy of each report made by the foundation's personnel or independent auditors of any audits or other investigations made during the taxable year with respect to any expenditure responsibility grant. So while it's not likely that the IRS will want to see these records, it is extremely important that the foundation keeps the records to show the compliance with all of the elements of expenditure responsibility. So those are the 5 requirements for a grant to qualify as an expenditure responsibility grant. Now let's turn to a short discussion of the penalties if a grant that is otherwise treated as a taxable expenditure and for which the ER requirements were not met. So if a private foundation makes any taxable expenditures, it's liable for taxes on the amount of these expenses under the Internal Revenue Code. The taxes are imposed on both the foundation and on any foundation manager or managers who knowingly and willfully agree to the inappropriate expenditure. So there's an initial tax and an additional tax. First, the initial tax. These are the 2 taxes on the foundation itself and on the foundation managers. The initial tax on the foundation is 20% of the taxable expenditure. So if it was a $100,000 grant, the tax on the foundation is 20% of that amount. so $20,000. The foundation is not liable for the tax, though, if it can show that the expenditure was due to reasonable cause and not to willful neglect, and the expenditure was corrected within the correction period. All of those are terms of art. I'm not going to go into those in detail on this episode, but there are many, many rulings and reports on what qualifies as reasonable cause and the requirements for correction. So in addition to the tax on the foundation, if the foundation manager or managers knowingly, willfully, and without reasonable cause agree to the taxable expenditure, the initial tax on the manager is 5% of the amount spent, up to a maximum of $10,000 for any taxable expenditure, any one taxable expenditure. So if there are multiples, the tax can apply on each one. The foundation manager who acts on advice of counsel given in a reasoned legal opinion in writing would not be liable for the tax. So that's an important exception. So that was the discussion of the initial tax, or what we often call the first tier expenditure responsibility tax. There's a second additional tax that applies if the expenditure is not corrected within the taxable period. And that additional tax is 100% of the amount spent on the taxable expenditure. That tax is imposed on the foundation. This second tier tax is not assessed, or if assessed, can be abated by the IRS if the expenditure is corrected within the correction period. Any foundation manager who refuses to agree to any part of the correction must also pay an additional tax of 50% of the expenditure, up to a maximum tax imposed on the manager of $20,000. The reasonable cause exception in brief that applies to the foundation manager's actions, the reasonable cause is found if the manager has exercised responsibility on behalf of the foundation with ordinary business care and prudence. Willful agreement to a taxable expenditure, another element of the foundation manager analysis of whether they're subject to the taxable expenditure penalty, is defined as follows. The agreement is willful if it's voluntary, conscious, and intentional. No motive to avoid the restrictions of the law or to incur the tax is necessary to make the agreement willful. However, a foundation manager's agreement to a taxable expenditure is not willful if he or she does not know that it is a taxable expenditure. Now, as I mentioned, these are all terms of art and defined in great detail in other authorities. So if that's a concern, take a look at the show notes. We have links to more materials that will help you track down the meaning of these exceptions. A final note on the foundation manager excise tax for violating the taxable expenditure rules is that if more than one foundation and manager is liable, all the managers are jointly and severally liable for the tax amount. So that's all for this episode. Be sure to check out the show notes for links to resources on expenditure responsibility rules. Also, Farella, Braun, and Martel now has a YouTube channel, and there are several nonprofit playlists, including the one we are building covering special topics for private foundations. So look for that link in the show notes if you want an organized collection of relevant podcast episodes. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun, and Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.